3. All right. Ladies and gentlemen, thank you for attending our meeting. Today we have an interview with Sufyan Khan. Sufyan Khan is a regional product manager, IFRS and IFRS9 and tax from AxiomSl. Sufyan has more than 13 years in the area of sales, client service and business development and product management, where in the past 7 years he helped clients make informed decisions in the area of trading and best practices across enterprise risk management. As of 1st of January 2018, corporates will need to comply with the new IFRS 9 standard that will have a significant impact on how financial instruments are accounted for. These changes may directly impact the P&L and corporate balance sheet. So today I would like to ask a few questions to Sufyan. Sufyan, could you please answer what are the main challenges in implementation of IFRS 9?
Okay, so first and foremost, thank you very much, Boris, for this interview. If you actually look at the previous standard, which was based on IS39, which was previously more of just more related to a finance function. The whole advent of IFRS 9 is just not a finance function anymore. It's more related to risk. It's more of amalgamation of finance. It's amalgamation of technology working together. So, for example, the previous directive was more on the incurred loss approach versus IFRS 9, which is looking at more of a forward-looking approach. And then that's where the risk and finance have to work, collaborate and work together. And I think that's one of the key challenges, because you are looking at a challenge of reconciling data across risk and finance. You're looking at the availability of the models. We are looking at generation of the models. And again, these models are looking at the PD and LGD models, but they're just not looking at the historical data. You're looking at forward forecasting of the model, which means you're not looking at the previous regulation said it's an incurred loss, which is at this point in time right now, if the loss incurred. But in IFRS 9, it's future forecasting that what if the loss incurred? And in that scenario, you have to generate the probability of default based on macroeconomic factors. You're looking at the loss given default. And there is a huge amount of data which is generated, because you're just not looking at one number. Another big factor and one of the big differences between IFRS 9 and IS39 is that you're looking at the present value of future cash flows which are being generated. And that means generating huge amounts of data, huge amount of cash flows. You're forecasting it not from 1 year, but you're looking at for the entire lifetime value of the asset. And that's huge amount of data which is being generated, huge amount of calculations which are being generated, huge processing which is going behind it. Running it according to multiple scenarios and according to multiple simulations is necessary. So I think that's where it becomes a huge exercise, not just from risk, not just finance, but it's very technology heavy directive. And again, the fact is that even once the results are generated, even it's from a quantitative element, but it's also qualitative assessment which needs to be done. There is a model validation process which needs to be done. Banks have to see, and including financial institutions have to see what is the impact they will have on their balance sheet with the new provisions. Like, to be honest with you, in the previous Deloitte surveys, if you've been seeing, there was a 30 to 40% jump in provisions, which used to have an impact on the balance sheet. And obviously, it's tapered down a lot more because banks have been taking action towards it. But it's still a huge jump in your P&L. It's a huge impact on your P&L. It impacts your provisions, which means in turn, it impacts your Tier 1 capital. So yes, the challenge is not just from a calculation perspective. The challenge is on the qualitative perspective. The challenge is on the data perspective. The challenge is on the risk management perspective. The challenge is also of alignment of two different teams, which is the CRO and CFO function together. So it's a lot which goes into the IFRS 9 directive.
Okay, great, thank you. Sufyan, could you please tell me in the main details, how is it possible to integrate risk and finance within IFRS 9?
I think that's one of the things which could have happened quite a while back. It's just that with the directive coming into picture, it's becoming more, the regulator is actually pushing the pressure that you need to be more IFRS 9, you need to have your risk and finance data integrated, which means you need to be reconciled. That means anything, what a lot of the banks face is reconciliation issues. And I think that's where the key challenge is. Yes, if your risk and financial data is actually reconciled, it's like half your battle won. And I think that's where it's important that you have to have some sort of a flexible infrastructure. Your technology has to be flexible enough where I can reconcile my data easily. Additional data, if I get, it needs to be able to reconcile from my ledger to my sub-ledger. Account level information needs to be reconciled. Risk should be talking the same language as finance. Finance should be talking the same language as risk. Both CRO and CFO should be aligned. And I think that's where it's just not the data, it's also the cleanliness of the data quality process comes into picture. And I think that's where I think it's a lot of pressure on IT and technology where to get the right data aligned, and also the right data has to be reconciled, and how flexible and how easily it needs to be reconciled. I think that's one of the key challenges, and that's where it's extremely important for banks, whether it's small, whether it's large. They really need to have, I would say, user-friendly technology infrastructure in place. As and when data increases, they should be able to reconcile it.
All right. Okay. Tell me, please, Sufyan, how can you source new data attributes in this environment?
Okay. If you're looking at from a banking technology point of view, I think that's one of the things which we see is lack of flexibility. With the IFRS9 function coming into picture, new data, new attributes, new cash flows, new risk parameters, I think all of this is considerably increased a lot, substantially increased a lot, I would say. And I think that's where it becomes extremely important to have a flexible infrastructure. This is what I was highlighting. Flexibility to have my model, flexibility to see my models, flexibility to see the results of the models, flexibility to see what are the qualitative and quantitative factors applied, flexibility to see what are the macroeconomic scenarios which have been generated. And so that's another new additional source data which I've required. If I'm looking at my asset size information, what are the cash flows being generated, not just from a 12-month, but lifetime value of the asset? It's a new amount of data, new amount of attributes which have generated. What is my loss given default? What is my results which are being generated, which I then need to map to my FinRep reports if you're looking from an EU perspective, or either this has to be mapped to my balance sheet. So again, new set of attributes which have to be generated and mapped. Also, I think from a shareholder's point of view and from a board point of view, what is the impact between the previous regulations, impact analysis? I think a lot of that data is actually generated, and I think you need to have a technology, you need to have an infrastructure where you can either source that information, you can either flexibly source that information. You don't have to go through a huge ETL or transformation process. You don't have to go through a logic where data is more proprietary. And I think we want to increase the user experience has to increase. It should become more of a business as usual exercise. It should not be a directive exercise. How they can extract the best out of this directive and apply it to their own business processes. That's the key thing which I think the business user should be looking at, and not just because the regulation is thrown at the banks or financial institutions.
All right. Okay. Sufyan, please tell me how banks can leverage their financial reporting data in this new situation as well.
Yes, well, absolutely. I think that becomes one of the key elements or starting points, because financial reporting data is obviously can be leveraged, but I think one of the key points to understand is that when financial reporting data, it's just not the aggregate, or I would say the sum of the values which are reported in any of the FinRep reports or any of the balance sheet information. With IFRS 9, it's not just the financial reporting, but it's contract level information where it needs to be audited or calculations have to be done. So the directive clearly states it straight that your expected credit loss needs to be computed at contract level, which means the values of which are using for your financial reports, the contracts which are being used for your financial reports, including GL postings, the GL codes, they have to be computed in contracts. So yes, they have to be aggregated for the financial reports, but at the end of the day, computation and calculations have to be done on a very granular level. Yes, you can leverage the data, but only and only it's leverageable if you actually have, or it can be leveraged only if you have the level of data as per the contract too, not just top line number. You're also looking at what is the depth inside it. And I think that's extremely important, because that's increasing, so that down the line, it's just not from a regulatory audit or a audit from your auditor or internal auditor, but it's the own bank which actually can see what calculations are happening on the contract level. Where is my exposure high? Which contracts are actually, or which GL accounts which are actually falling or which assets are falling more in the stage 2 category, which are falling in the stage 1 category. What is the impact on my exposure? Why is my provision numbers going up? I think that's where it's extremely important that yes, you can leverage the financial, but only leverage, it can only be leveraged if you have the level of data on a contract level and not just on the top line number.
Okay, great, thank you. Sufyan, how does your IFRS 9 solution of your company, AxiomSl, support scenario and impact analysis?
Okay, I think what we have done is, from Axiom's point of view, we have tried to increase the user experience and make it better. We've tried to make it end to end, which means we are just not just taking the data on one side. We're also going through a data quality check process, and we have made the solution as flexible, which means down the line, if you want to get more data inside the system, you have the level of flexibility, which means you're just not looking at the previous data results of the previous regulation, but also the new regulation which is coming through. And we also have increased the flexibility where you can have client models, you can generate and execute PD and LGD models inside the system, you can generate the cash flows, all the way to the calculations, all the way to GL postings, all the way to the report generation. And the reports also we are generating, like for example, one of the reports which is on impact analysis is the IFRS 7.35 return. That actually tells you what is the impact between the previous results versus the new results. Our system pretty much does that extremely flexible approach. It's a one-click workflow which we have provided for our clients. It's not a huge process involved. We're trying to reduce the total cost of ownership for the client, but make it the entire process so automated that you can run the workflows, you can run and see what the results would be as per the previous regulation versus the new regulation. And if I want to run not just a regulatory scenario, but if I want to do an impact analysis based on my own scenarios and from my own bank's internal assessment perspective, I should be able to do that. And we have done that. And that's what we have given our clients, we have offered our clients. So for example, just to give you a bit of a user experience, some of our clients right now are not just running the regulatory process from a regulator's point of view, but they're doing their own impact analysis to see that what would be the impact on their provisions if certain global macroeconomic scenarios took place. And they're running this not just on a group level, but they're running it on the entity level for the different locations there, because every macroeconomic factor would be different for every region. So that's what they're able to run and see the current impact and how that ties down to the group level. So that's the level of flexibility and automation we have tried to provide to our clients. That gives them flexibility, that gives them transparency. And I think one of the key points which we have tried to highlight in the solution is that the auditability, which is extremely important. We have kept the models open so that tomorrow the auditor comes, they can validate the model. We have kept the calculations open, which means they can, end business user could probably drill back from the results all the way back to where the data actually originated from. So it's not just one or two steps, but all the way to identify where the data actually originated, whether it's financial data, whether it's risk data, whether it's PD level information, whether it's LGD level information. So that's the level of flexibility, or that's the level of user experience we have tried to build within our solution.
Okay, thank you. I think maybe a last question that I would like to ask you today. What mistakes do you see with organizations trying to implement this solution, IFRS 9?
I think I think everybody right now, what we see is everybody's on the push towards crossing the deadline. And I think what we see is, I think one of the key points which organizations should look at, they should look at a strategic approach. They should look at a strategic point of view, not tactical. I think that's where it becomes important that organizations should not be working with a patchwork of systems, patchwork of Excel files. What they really should be doing is looking at taking a step back and deciding, okay, we need to get through this regulation. We need to get through this regulatory deadline. How can we ensure that this is just not a crossing the deadline activity, but this becomes as a business as usual activity going forward, which means if I run the process, how easily can I generate my numbers? How quickly can I do my result? How quickly can I go through an audit? I think that's a strategic approach which should be taken by banks and institutions. It's just not looking at how I can just cross the regulatory deadline. Okay, the regulatory deadline will be crossed, but what about next? What about the next deadline? What about the deadline after that? Are you going to be struggling again? Are you again going to be dealing with a patchwork of systems or Excel and flat files? Or are you going to be looking at an infrastructure which is more scalable, which means down the line, if your business increases, are you going to add another Excel file, or are you just going to just load the data and see what the results would be with my new business addition? And I think businesses are going to change down the line. For example, a bank today is going to a lending activity in another sector. They might start expanding in another sector. So how flexibility and what's the impact going to be on my provisions with the new addition of the new set of asset classes? I look at that. Can I be able to run that then automatically? So I think that's where really banks and institutions should be looking. They should be looking at a strategic approach. They should not be looking at tactically. That it's more tactical approach is more like a patchwork. It's only short term, but it's not going to help you in the long run. And I think that's where it's important that you really sometimes you just got to take a step back and think how this would fit in my entire infrastructure.
All right, thank you for your interview today, and I hope we will have more questions after that from our members. And for the time being, I am stopping the recording. Thank you.